Between January 8th and January 15th, something truly unprecedented unfolded in the silver market. Nearly $5 billion in institutional selling pressure hit the market in a matter of days, yet silver refused to break down. Prices should have collapsed. Analysts expected a sharp correction. Instead, silver held firm and in some cases moved higher. At the very same time that paper selling dominated headlines, physical silver was quietly disappearing from dealers worldwide, with premiums reaching levels never seen before. While futures prices hovered near $80, reports from physical markets told a completely different story. Shanghai saw silver trading as high as $84 an ounce. In other regions, premiums surged even further. The disconnect between paper prices and physical reality became impossible to ignore. Something was clearly wrong with the official narrative, and the numbers simply didn't add up. Behind the scenes, one nation alone accumulated enough silver in just 4 weeks to absorb roughly 35% of global annual mine production. At the same time, over 300 institutional investors positioned themselves for the exact opposite outcome, being promoted by mainstream analysts and financial media. The question became unavoidable. What did they see that the broader market was missing? Welcome to CSC Alert. This is a place for those who prefer facts over noise, mathematics over hype, and long-term understanding over short-term fear. In a world where financial news is driven by alerts and algorithms, this channel exists for people who still believe in sitting down, slowing things down, and actually reading the data. If you remember when financial insight came from newspapers instead of push notifications, you're in the right place. Before we go any further, take a moment to subscribe. Think of it as keeping a morning paper subscription alive, except this one is designed to help you protect your purchasing power in an increasingly unstable financial world. Click the button so you don't miss what's coming next. And I'm genuinely curious. Let me know in the comments where you're watching from. Are you in Mumbai watching physical silver vanish from local dealers? In Sydney, seeing premiums go vertical? In Chicago, wondering why futures prices don't match what's happening in the real world? Or maybe you're in a small town trying to understand why your financial advisor suddenly stopped talking about precious metals. Wherever you are, you're part of a community that values clarity over clickbait. Now let's talk about what actually happened. Every January, commodity markets experience a technical event that most investors never notice. Index funds rebalance their portfolios. Normally, this causes a small ripple, maybe a 1 or 2% adjustment, and then markets move on. But in January 2025, silver faced something far more extreme. The Bloomberg Commodity Index announced it would reduce silver's weighting from 9.6% down to just 4%. On the surface, that sounds harmless. In reality, it forced passive index funds to dump between $5 and $7 billion worth of silver futures. This selling had nothing to do with fundamentals, nothing to do with demand, nothing to do with supply. Silver was being punished simply for outperforming other commodities. The rebalancing window from January 8th to January 15th instantly became one of the most closely watched periods in precious metals history. Major institutions lined up with their forecasts. TD Securities publicly recommended shorting silver. Popular YouTube commentators warned viewers to get out immediately. The message was unified, loud, and confident. Silver was about to collapse. Then something strange happened. On January 8th, silver opened lower as expected. Traders piled into short positions. But by Friday, January 9th, silver surged more than 3% in a single session. Instead of collapsing under massive selling pressure, it rallied. Short sellers were caught off guard, and the market refused to behave the way it was supposed to. The CME Group had already tried to cool things down. Margin requirements were raised multiple times in the weeks leading up to January. This tactic has been used repeatedly throughout history to suppress silver rallies. It worked in 1980, it worked in 2011, it worked in 2020, and again in 2021. Raise margins, force liquidations, cool enthusiasm. But this time, the playbook failed. Even with higher margins, forced selling, and non-stop warnings, silver would not break. More experienced market participants noticed something even more alarming. The normal structure of the silver market had inverted. Under normal conditions, futures prices trade above spot prices due to storage and carrying costs. This structure is known as contango, but in early January, spot silver began trading above futures. Physical silver was more expensive than future delivery. Shanghai reported silver at $84 an ounce, while March futures traded near $80. This phenomenon, known as backwardation, only appears when immediate demand overwhelms available supply. It is the market signaling a physical shortage. Yet the narrative never changed. Analysts continued to warn of collapse. Media continued to focus on the rebalancing. But professional traders were reading a very different story in the data. $5 billion in forced selling met an immovable wall of physical demand. Margin hikes failed, warnings failed, and prices refused to comply. By January 10th, nearly half of the rebalancing period had passed. Every technical factor suggested silver should be lower. Instead, it was stable and strengthening. The real question shifted from whether silver would collapse to what force was strong enough to absorb all of this selling pressure. The answer was unfolding quietly on the other side of the world. In India, a historic accumulation of silver had begun. Between mid-November and mid-December, Indian silver ETFs absorbed over 22 million ounces in just 4 weeks. When analysts ran the math, the implications were staggering. At that pace, India alone would absorb nearly 300 million ounces annually, roughly 35% of global mine production. And this was just ETF demand. It didn't include jewelry, industrial use, bullion purchases, or household savings. India's population represents nearly 18% of humanity, and silver has been embedded in its culture for thousands of years. But something new had changed. Indian banks began accepting physical silver as loan collateral. That single shift transformed silver from a traditional store of value into a formally monetized asset within the world's 5th largest economy. At the same time, digital platforms allowed citizens to buy fractional silver stored in insured vaults using mobile apps. A farmer, a shopkeeper, and a software engineer could all accumulate silver as easily as opening a savings account. Western media barely noticed. Meanwhile, the math became impossible. Global silver production sits around 830 million ounces per year. Industrial demand consumes roughly 550 million ounces. That leaves less than 300 million ounces for investment and inventory. India alone was absorbing nearly all of it. Physical premiums exploded worldwide. China reported premiums far above futures prices. Australia, Europe, and North America faced multi-month delivery delays. Arbitrage broke down because physical supply simply wasn't available. Paper prices no longer reflected reality. At the same time, the ratio of paper claims to physical silver reached historic extremes. For every ounce of registered silver on COMEX, there were hundreds of paper claims. A small percentage of delivery requests would overwhelm the system. And then came the macro backdrop. Weak employment data gave the Federal Reserve cover to maintain loose policy. Defense spending surged. Mortgage markets received intervention. Central banks globally continued expanding balance sheets. Currency debasement accelerated. Gold responded first, breaking to new highs. Silver followed, but with a unique twist. Unlike gold, silver is irreplaceable in modern industry. Solar panels, electronics, medical devices, and infrastructure all depend on it. This dual demand created a supply squeeze unlike anything seen before. By the time the rebalancing window neared its end, institutional behavior had quietly shifted, while public recommendations screamed short, smart money, positioned long. They understood a simple truth. When everyone expects the same outcome, markets often deliver the opposite. The selling pressure would end. The physical shortage would not. And when paper prices are finally forced to reconcile with physical reality, that adjustment will not be gentle. This isn't a corner. It isn't speculation. It's a global shift in how silver is valued, used, and accumulated. You can change rules on traders. You can't change culture. You can't margin call a billion people. The question now isn't whether silver survives this moment. It's how violently the market reprices once denial breaks. This is Jon Money Discipline. If you value clear thinking over fear and real numbers over narratives, make sure you're subscribed to the channel. Stay informed, stay disciplined, and I'll see you in the next one.